how lucky we are to call this beautiful continent home. Yes, this paradise is not without peril, but just look at what we have to work with. In the years to come, this responsibility will fall to you, and all its potential will be your possibility. So we promise to do all we can today to share all our knowledge and skills, to ensure you inherit a just society, to give you access to the finance and resources you need to build the best Africa possible. But none of that will matter if we don't protect this beautiful continent we call home. And so we pledge to use every ounce of our creativity, our ingenuity, our tenacity, all 37,000 of us, shoulder to shoulder with millions of you, to bring the most important possibility of our time to life. So your world, dear tomorrow, is shaped by the power of zero.
Africa is a continent open to possibility, which comes to life when those with ambition and courage find the right partner, a partner with the tenacity to stand by them and light up a continent. With the experience and unique insights to go beyond limits, Absa Group Limited is that partner. We are synonymous with stability, transparency, and innovative thinking in financial services based on a legacy of 100 years of seamless execution across Africa. Our new brand and growth strategy define how we are shaping our destiny as a proudly African bank, inspired by Africanacity. This is the distinctly African ability to always find ways to get things done. Africanacity is what drives us, what sets the tone for our business, and echoes across our African footprint. Our corporate and investment banking business challenges limits. We close distances, connecting people to opportunities across borders, languages, and cultures. With global connectivity and local differentiation, we operate at the core of your strategy. Our understanding of each unique environment across regulatory and market practices results in a differentiated service and experience for our broad range of clients. Backed by insights into key sectors, we turn risks into opportunities, supported by a unique set of solutions that work across your full value chain. Our clients experience a seamless partnership across Africa, with aligned delivery positioning you for success across operating environments. Because African ingenuity and tenacity go beyond limits, so do we. Our world-class service is based on skills and expertise that have been developed to put our clients first, proven by numerous high-profile deals and coveted international awards. We are brave, we are passionate, we are ready. We are independently African, and we believe in building courageous partnerships that work. When you have the bravery to imagine and the will to get things done, that's Africanacity. That's Absa. Corporate and Investment Banking.
Back. We are having an important conversation today that obviously couldn't get everybody in the room, and for that reason we will be streaming this conversation live on YouTube, Facebook, and LinkedIn. The hashtag is AFME2022, so please do not switch off your phones. There's totally free Wi-Fi in this room. Log in, get there, and let's connect. Is that okay? Okay, now let's start properly. Good morning, ladies and gentlemen. Okay, we're doing it for TV. Good morning, ladies and gentlemen. Thank you, thank you. Good morning and welcome to a very important conversation about us, about Africa. And I'm really proud to stand here before you to be part of this conversation. My name is Boni Tunya. I am a Pan-African journalist. I've spent most of my work talking about the financial space on the African continent. And I'm really excited to be part of such a conversation today where we take stock of how far we've come, we look at the challenges, but also we get to appreciate the great work that is already happening on the African continent. And that is indeed the potential that is in the African capital markets. Ladies and gentlemen, the African Financial Markets Index is on its 6th year, and just speaks to the breadth of information, data, knowledge, and learning that has been shared across the 6 years. And the good people at Absa convening this is basically giving you as an investor, as a concerned African, a chance to have a tool that will help you steer in these very dynamic times. And so today we'll hear stories of resilience, we'll hear stories of hard work, triumph, innovation, and courage. But most importantly, we'll try and find where do you find your peace as an investor, as a regulator, as a participant of this African opportunity. We will try to understand exactly how we can harness the potential that is Africa as a market while taking stock of its position globally, and also not obviously downplaying the global geopolitical times that we do find ourselves that have been particularly difficult for business. And so without much ado, ladies and gentlemen, first allow to acknowledge the interim managing director for Absa Bank Kenya, Mr. Yusuf Omari, the chief executive officer for the Nairobi Securities Exchange, Mr. Jeffrey Odundo, the director of policy and market development at the CMA, Mr. Luke Ombara, the head of markets at Absa Bank Kenya, Madam Stella Mambo, the managing principal corporate and investment banking, Mr. James Agin. Distinguished ladies and gentlemen, good morning. Like I did mention, the conversation about African markets is one that a lot of people are interested in, few people know about it, and even fewer people are participating in it. And this is down to lack of awareness, lack of data, and generally just people don't know. But this has been changing on the African continent if you do have a look at some of the data that we've been able to capture, and if you've been following this over time. There's been deliberate steps at pricing the African market, at understanding risk, but also at taking advantage of the opportunities. And that is been well captured in this report that you'll be hearing more of today. And like I did say, this gives a glimpse of an Africa that is not rising, but an Africa that is risen and ready for business. Because we keep talking about that past Africa, and we talk about it as though we live outside that continent. This is an opportunity to really have a conversation about the markets in which we do exist in, by critically looking at the opportunities that do exist, but also taking stock of how far we need to go. And so I invite you to really try and find what is your role in this. How can you use this data that is so sufficiently provided here? And how can you imagine an Africa that is fully harnessing its potential? This particular study has cut across several jurisdictions on the African markets. Markets that previously didn't exist or we didn't know about, that are now competing, that are now participating, that are now attracting investment. And that is the story of the African Financial Markets Index. That there are places that were little known, places that were indeed dark in an even darker continent. But now they're opening up for business. They're digitalizing their systems. They are innovating solutions, and they're involving local investors in those conversations. We look at markets like Angola, like DRC, like Botswana, and improvements in sophisticated markets like Kenya, like Mauritius, South Africa, and Nigeria. And it just paints a picture that perhaps the Africa we talk about and the opportunities that we do talk about haven't been fully grasped, especially by the investors and the players in this space. And so we are hoping that today, through this report, it will give you a better dashboard into what's happening on the continent and exactly where you can plug yourself in. But I don't want to hog the limelight. It's good manners to bring your host to formally welcome the guests. And so, ladies and gentlemen, it is my pleasure right now to invite on stage the interim Managing Director for Absa Bank Kenya, Mr. Yusuf Omari, to give you a formal welcome. Welcome, sir.
It's good to be here. I hope you guys are also happy to be here. Geoffrey Odundo, CEO, Nairobi Securities Exchange. Luke Ombara, Director Policy and Market Development, Capital Markets Authority. Our distinguished guests who have been able to join us here, and the ones who are watching us live in different platforms. My colleagues in the bank, members of the media, ladies and gentlemen, good morning. Good morning. I hope we've had breakfast. It's indeed a great privilege for us to host you once again for this exciting session that we take some time to have a deeper look at the development that have actually happened in our financial markets. And more so noting, the kind of challenges that we've had, be it from a macroeconomic perspective, geopolitical risks, etc. For the last 6 years, Absa Group, in partnership with the Official Monetary and Financial Institutions Forum, has published and released the Absa Africa Financial Markets Index, what we call in short AFMI, which presents a broad view of the continent's financial market progress and the vibrancy that we see in this continent. The strength of AFMI has always been the discussion, the learning, and development it fosters across Africa. I have no doubt that this year's contribution will equally be beneficial to our clients and the investors who have to make critical decisions, especially when it comes to issues to do with investments. This year's index comes against the backdrop of lost progress over the previous 2 years due to the pandemic that I've just mentioned. We know the impact that we got from COVID, with the war in Ukraine, and its global consequences posing new challenges. The uncertain macroeconomic challenges highlight the importance of strong local markets in terms of mitigating the external shocks. Without a doubt, the COVID-19 pandemic had a significant impact in the global economy and businesses around the world. However, we are glad that in Kenya, in our usual ways of recovering and going through these troughs, we've managed to overcome, and the vibrancy of the economy can be felt. That's what we call Africanacity, knowing how we resolve and address our unique challenges. Referring to the index, we are encouraged by the great improvements by countries in their financial markets across the pillars as tracked by the AFMI report. Most of these improvements are supported by the individuals, nations' investments in strong financial markets and infrastructure, looking at the legal framework that is underpinned by the rule of law and increased vigilance by the Capital Markets Authority. In this year's index, I am delighted to note that Kenya's ranking has moved up 2 places to rank 8th from a ranking of 10 in the previous year because of better environmental, social, and governance market frameworks. Kenya was also among the countries with increase in scores, rising 61 points, up from 55 points in a similar period last year. These improvements are not by chance, but a reflection of the continued focus by countries to foster financial market ecosystems that is better placed to meet Africans' financing needs. Distinguished guests, on our part, the index presents us an opportunity to demonstrate to our stakeholders across the world that we maintain our commitment to the African continent and shows our ambition to bring possibilities to life, contribute to the growth of this country, continent, and to our people by bringing such contributions. For us, the index is an important tool for policymakers and market participants to have open discussions that will improve and help build robust financial markets that can drive inclusive growth. More locally, a key player working with key industrial stakeholders led by regulators such as the Central Bank, Capital Markets Authority, NSC, we have been at the forefront of delivering initiatives that continue to transform our capital markets space. For example, in the past, we collaborated with CMA to launch the 10-year Capital Markets Master Plan, which was critical in guiding the development of our markets. In addition, we were the first financial institution in the region to list an exchange-traded fund, the New Gold ETF, after the NSC and the Capital Markets Authority enacted regulations allowing these instruments. As a further commitment to deepening our financial markets, we have also started our greenfield re-entry into the custody business. This is for the bank, to capture opportunities in foreign currency, deposits, and also the ecosystem that is normally created with one financial institutions under one umbrella. In addition, and to complement our leading global markets and stock brokerages businesses, we have invested in investment banking advisory to capitalize on opportunities in mergers and acquisitions, as well as the debt and equity capital markets across East Africa. I'm also delighted to note that our newly introduced Absa Kenya's unit trust scheme recorded the fastest growth in the collective investment scheme sector in the quarter ending June, hitting 1.05 billion in assets under management. And ladies and gentlemen, that was in June. I'll tell you this figure has significantly increased, and you'll be able to see that during the next reporting period. We therefore look forward to continue working closely with the CMA and NSC to try and capture that savings culture that has also been mentioned in the President's manifesto and becomes one of the key targets that we are putting as part of the country's economic development. In conclusion, ladies and gentlemen, we remain committed to furthering the development and prosperity of the continent and its people. We trust that the insights embodied in the index will inspire active engagement among policymakers and market participants, resulting in measurable actions that foster inclusive growth and also sustainable growth. So our colleagues are here. I know we will have some moment where we'll have Q&As. We look forward to that. And we have different participants who will come in front here. And I just hope that you'll be able to gather a lot of insights from this research that has been done, and we'll make sure that these kind of insights are consistently delivered to you as our guests. Thank you so much, and enjoy the sessions.
Thank you so much, sir, for that warm welcome and painting to us a broad picture of what we expect today. We've talked a lot about this report, so how about we jump into it, right? Ladies and gentlemen, allow me to, I'd like you actually to, if you could just train your eyes to the screens right now, we'll be joined by the head of macro and fixed income research for Absa CIB, joining us from Johannesburg, Mr. Jeff Gable.
sorry, technology issues here. One second. Good morning, everybody. I think as a team, let me just try and see whether this is working now. Okay, great. Great. Thank you, Jeff. Very good morning to one and each and everybody today. And once again, thank you so much for joining us for the 6th Absa Africa Market Index Launch 2022. So my work seems to be a little bit easier. So when Kenya Airways decided to cancel the flights, Jeff and I agreed that I'm going to do the presentation, but all the hard questions will be directed to Jeff. So I'm very happy that he's still online, and he's happy and more than willing to take up the tough questions. So I'll dive in straight to it. So Jeff has done a couple of things. He's outlined for us what the Absa Africa Market Index partnership is with OFAM, which is the official markets financial institution forum. When you think about that forum, is what we call a think tank organization, and their mandate is primarily just to look at the central bank environment, public investment, as well as the economic policies that the central banks and the government put in place. The purpose of that partnership was to try and help the Africa continent to have a base where they can reference for just market practice and to be able to learn where, what the progress has done from a capital market perspective. I think this is a good initiative and one where we are proud of as Absa Bank. But just to deep dive around how do we come up with this index, Jeff has spoken around what measures or metrics we put in place to come up with the scores for each index countries. We do have 26 countries right now as of 2022, and we kicked off in 2017 where we were barely 17 countries. That progress that we're making with OMFAM is quite remarkable. So what I'm gonna try and do right now, I'm gonna deep dive into the 6 pillars that form what you call the measurement metrics for the different scores across the index countries, and I'll kick off with what we call the market in-depth. What does the market in-depth index does? So it does 2 things. One, looks at the size and liquidity of the domestic market and analyzes the depth around product that that market is able to offer to its sort of investors. If you look at that chart, you got 5 indicators, what we call indicators, which is the size of the market. I hope you can hear me. Liquidity, product diversification, depth, and primary dealer system. The pink, what I call fuchsia dot, 2021 Pillars 1 score, gives a score that was there last year. The pink, more brighter pink, or baby pink, line, Pillar 1 score, gives a score for 2022. And that just gives you an analysis of what has been happening. Obviously, because of the biggest market we have over the continent, that's South Africa. But obviously, what we've seen also this year, which has been quite interesting, is that that has also sort of fallen in terms of market capitalization. I think COVID was a gift, but the biggest gift we've gotten is the macro environment that has shaped up. And 4 things that have come up is, currency depreciation across the continent. We've seen inflation, which is quite sticky and progressing quite aggressively there, as well as just the macro environment that's driving that. So just to look at this pillar and where Kenya is, I think what is important to note is that as a result of that macro outlook, the capital market stabilization for the Africa has fallen off by about $210 billion across the 26 countries. If you compare that to last year, you're talking about a dip of about 13% year on year. But what's important in terms of this pillar is we looked at the indices like product diversity as one of the factors to consider, as well as size and liquidity. Those are the three indicators that have been trying to move this dial. So for countries like Morocco, if you look at my extreme right here, 10% increase. What has happened for Morocco is they've actually introduced what you're calling the overnight index swap curve. And what that does, it helps them to be able to manage interest rate risk. I know the name sounds like it's an overnight curve. No, it's not an overnight curve. The index, so the reference rate is overnight, but then you can price whatever tenor all the way to as long as 10 years. Then if you think about countries like Nigeria have introduced a central bank digital currency, what they're calling the e-Naira. Now that's operation, and what that does is just improve the payment system within the country. You heard from Jeff, if you look at Angola and Lesego, they've done their initial IPOs this year, which is quite fantastic, and that sees to why they've actually scored very highly from a high product perspective. So I'll move quickly to the Kenyan pillar around the market data. And quite interesting here on this particular one is two themes that came out. One, product diversity as one of the indicators, and then the other one was around size and liquidity of the domestic capital market. I'm gonna zero in on the product diversity for now and look at what are the themes we're seeing across the different asset classes, which is quite interesting because if you think about the asset classes are there, you got what you call your equity space, you got your debt market space, and you got your commodities and derivative market space. In that particular pillar, if I look at what has happened from an equity perspective, we've seen introductions of what we are calling REITs, real estate trust investments. We also got the gold ETF that was introduced by Absa. So a lot of ETFs right now happening into the market. I think that has been happening on the debt side, on the equity side, sorry. If you look at the debt side, you do have your government securities profile, be it from a treasury bills, treasury bonds that are coming up. Corporate bonds, obviously not doing well in Kenya. And if you look at the bottom there in terms of areas of improvement, that's one of the areas we think Kenya can do better from issuance from a corporate bond perspective. And then we think about broadly, when I touch around NSE and the Capital Market Authority. From an NSE perspective, we've seen them introducing what we are calling the direct market access trading, specifically for the equity business. You can trade online, and that's already in operation, and one where it helps just to drive in terms of market efficiency. The other one from our Capital Markets Authority, and we've spent a lot of time looking at the strategic plan for Capital Market Authority. We've been able to pick up a couple of items or a couple of solutionings that the market is trying to open up. We've already seen there's a framework for green bonds in the market. In 2019, Econ used the green bond framework to raise about 5 billion shillings from a medium-term note, and that money was basically used to put up 5,000, what we call environmental-friendly student housing. And that was quite a success. And on the backdrop of that, there's a lot of requests coming through around ESG or sustainable financing them to try and drive that. So I'll move on to the second pillar, which is pillar number 2. Access to foreign exchange, important because it helps a country understand whether there's that openness from a foreign investment. Obviously, if you think about the capital markets, foreign investments becomes quite key. So what's interesting on this pillar is we got 3 indicators that we used to measure. Jeff spoke about it earlier. There's one thing that has changed this particular year from a measurement point of view, and that's on the reserve adequacy. Traditionally, how we used to measure this was around the total portfolio flow returns. We've coined it a little bit differently this year, and we are now measuring that in terms of import coverage. And that's quite important. If you think about Kenya, we're supposed to hold import cover of roughly 4 times of our import bill, and that's quite critical. The other item is on FX liquidity, as well as FX arrangement and controls. If you look at this pillar, there's something quite interesting. I think because of the macro environment that I painted earlier around inflation, currency depreciation, heightened rates across the developed markets. We've seen the Fed hiking rates, the Eurozone rates were negative. We've seen a shift, or what we're calling shocks in the market. And to give you a sense, out of these 26 index countries, IMF has actually come in to support 10 of these indices, and that support has been the tune of about 1.6 billion. It needs to realize and try and put what I would call shock absorbers for this externalized market environment that we have no control of. And if you look at also at the survey around what's the biggest risk that we are facing, I think cybersecurity comes first, and the second one is just the macro environment that has just been evolving and quite vigorous. So you can see there Malawi, their reserves are really down just because of that, but again, IMF came in. Zambia, we've seen them also getting a bit of support from an IM perspective. I think what's interesting, you've seen Kenya has risen by about 29 basis points, and I'll explain that in the next slide. For Uganda, it's been more around availability of data around the FX interbank. I think that data has sold up and made sure that the numbers stack up. So I'll move on quickly to Kenya. So this is one where we looked at two themes in terms of the reserves levels. Beginning of this year, we're down about $9.9 billion in terms of reserves. We are sort of down to about 4.2 months of import cover. For Kenya, what was quite interesting is that stabilization the last couple of months in terms of the reserves, when you compare that to the other index countries, was quite impressive. I think the second thing I just want to highlight was on the FX liquidity. You can see that FX liquidity, the pink one, 3 to 18, quite a big jump, as you can see there. Or data around the interbank FX liquidity that you're able to garner in the market. Out of this, the survey we did, a lot of responded. ES is a capital market initiatives that we're seeing around the framework, around putting up financial literacy partnerships with the commercial banks, and just to try and get product across the asset classes, which is quite important. And we've been very fortunate as Absa Bank to be in that position, and we've already created a fully Frenched non-bank financial institution framework to be able to offer investors in terms of the different asset classes, be it from a funding perspective, whether you're looking for high-yielding investments or whether you're looking for an alternative way of managing your asset and liability book. So I did mention that's one of the area of improvement. Our score is quite low compared to the rest of the index, and one where we think is an area where Kenya can do much better. Pillar 5, quite topical. I didn't mention about macro environment being the biggest risks we are seeing across, especially from a financial perspective. Cybersecurity has now taken the top size, as I mentioned. But again, when on this particular pillar, a couple of items we look at, and your usual macro outlook, your GDP, your inflation, non-performing loans, external debt, which is something also sticky that are happening across the continent, macro data standards that are being applied, MPC, transparency. We're very fortunate from a Kenya perspective. We do have monthly MPC meetings, and those transparency from our report perspective that do come out in the market, and obviously the budget releases that happen. Kenya also very fortunate. End of June of every financial year, we get to see that. What is interesting here is, I'm not surprised because of this score of Botswana taking up the lead. If I look at the total debt to GDP of Botswana, it's actually the lowest. It's 23%. Kenya, we're about 70.3. Ghana at about 84. And that just shows why Botswana has come up there for a couple of reasons. One, they do have a very low external debt, what I've just mentioned. The NPL ratios are quite low, to be very honest. And they also have information in terms of transparency, which has been quite a good stamp. Inflation is something that has sort of, hurted most of the continent on the index counters that we looked at here. Obviously nothing in isolation, but again, due to the macro environment, I did speak to earlier on. In terms of top risers, you can see there, Zambia coming out quite strongly, as well as Seychelles and Angola, and one where, we keep monitoring what the macro environment looks like. I'll move quickly to Kenya. And for Kenya, we'll basically look at a couple of things. We measure external debt because we believe external debt, that's where the bigger score is, rather than the domestic, what the government uses domestically. If you look at that score it's the orange color there. Sorry for the men, I hope you understand orange. We moved from 9 to 8. And that external debt has grown from at about 32.1% to about 32.3%. I did mention about our debt levels. They are still progressing quite aggressively, and one where we just need to continue measuring. I think the other one for Kenya is around inflation. That also is ticking up, slightly up. We are shy of about 10%, closed the month of October about 9.6, 40 basis up if you compare that to September. But something positive for Kenya is, and quite interesting, and with the gift of the COVID, the non-performing loans have actually decreased. So we've seen that decline coming off from about 14.1 to about 13.1. I think also the efforts that the commercial banks did in terms of restructuring the debt also gave that reprieve, and possibly that's why we're not seeing a lot of non-performing loans across this portfolio. So in terms of areas improvement for this pillar for Kenya, external debt is something we need to continue watching, and where we believe they could be sticky as we progress. The NPL ratios remain still, even if they've decreased compared to the index countries, we are still relatively high. Some of these countries have what we call single digits in terms of NPL positions. Lastly, the last pillar is legal standards and enforceability. And this just speaks to the framework that the continent or the market has put in place to be able to compete from an international market lens perspective. For this particular pillar, it measures 3 things. It measures 1, use of standard master agreements. These are very critical, especially for both capital markets and derivatives transactions. For this particular one, there are 3 documents the index focuses on. One is the ISDA, what we call the International Swaps Derivative Association. I believe most of you who are in the room have had a scenario to interact with the ISDA documentation. I think that's very widely adopted in Kenya. But again, what we see from an ISDA perspective, even if it has been adopted very well in Kenya, the backdrop of that is that we don't have what we call closed netting out. And closed netting out is very important because it allows you to have one single settlement between each counterparty in the event there's actually a default. And that's quite important, and that doesn't incorporate in the Kenyan lens. The other documentation that we seek to score in this particular one, again in the breadth of how do we drive the capital market framework, is what we call the GMRA. It's called the Global Master Repurchase Agreements. It's a document that's used by international bodies to be able then to spur what we call the money market instrument. And some of the transactions traded, as the name suggests, is what we call repurchase agreement. I'm sure you've heard the name repo in the market. And it's basically secured lending, where you give your security to the bank, and the bank is able to advance you finance on the backdrop of that security. Quite an efficient way to try and get funding and just move from the traditional commercial loans that we all tap in. So why not utilize some of your assets you're sitting on to get some funding from the bank? I think that particular one, from our Kenya lens perspective, and I'll speak to it on the second drop, is we haven't scoped that, but I'll also just speak about some of the developments we are seeing in that particular space. The last document on the ISDA Master Agreement that we score on this pillar is what we call the Global Master Security Lending Agreement, GMSLA, sorry. And what that document also allows is specifically around getting exchange of funding based again on your securities you hold. And one of the initiatives, both the CMA and NSC is trying to incorporate into the market for holders like yourselves on a personal capacity. If you are holding some equities, then you can come again to the bank and give those positions of the asset of the equity portfolio holding, and then the backdrop of that we can be able to extend funding. And those are some of the innovative funding solutions that we are talking about that are coming across the continent. The second thing this pillar tries to underscore is around closing net provision that I spoke about. How do you close out in an event of default? How do you net settle among yourselves? And the last one is collateral provisions. What's interesting is Nigeria has moved miles ahead. They've been the third country in the index, just after South Africa and Mauritius, to be able to get a nod from the ISDA body from a clean netting position. So what that means is that the ISDA now has a capacity to allow for netting, which is a good comeback, especially for financial markets when you want to advance. The other one is, generally we've seen a bit of a lag in terms of score across the index countries. And we do believe this is an area where not only Kenya requires more in terms of getting across the curve, but again, all these index countries, you can see that line. We look at where the Pillar 6 2021 score was, the yellow dots versus the longer line that is maroon, Pillar 6. You've largely not even moved. So this pillar just shows that there's a lot of hard work and work needs to be done across the index countries to get this market development moving. So for Kenya, I didn't mention ISDA, widely adopted. We use that for all derivative transactions we execute as Absa Bank. We do ask both our corporates, non-bank financial institutions and financial institutions to execute that for anything longer than 6 months. The flow in that, it doesn't have that closeout netting provision. So in case of a default, you have to do the proper exchanges between the two counterparties. Not quite efficient for a market and an area where we need to progress that. The second one is, which is a very good development that has come, and Central Bank has done a fantastic job. They are introducing what we are calling a CSD system, what is Central Securities Depository System. And what that will do is that we'll be able to open up the secondary money market trading, especially for government and ring-fence structures around that. So now we'll be able to transact repos, we'll be able to do vertical repos, we'll be able to do what we call buy and sell back transaction. And what that means, it will open up financial markets. So currently as we speak, we've had a negotiation between Central Bank and the commercial banks. We are busy now executing what we call the MRA, the Master Repurchase Agreements. We're gonna do one with the central banks, and then obviously banks are gonna do bilateral sign-off between themselves to be able to kick off that. My belief, I think end of this month, those documentations should be signed off. Testing has happened. So I think this is a good welcome, specifically to the Kenyan market. And I do want to request everybody sitting here to just reach out to us and just understand more what that means to your business, because it's a good opportunity to try and tap that, especially for what I spoke about, alternative funding solutions that you're able to gain in the market. I think this is a big one. Where we've not scoped is the GMSRA, the security lending, and one where we'll continue looking at it and seeing what we can do. So as I come to a close, and specifically for Kenya, so what are the great performance? So obviously we've seen Pillar 3, which spoke about market transparency, tax regulation was topical. We scored their position 3, sorry, which was quite good. And the things that drove that was the ESG framework, as well as the climate stress testing that we've adopted in the market. I spoke about the capital gain tax that's potentially could come. Depending on where you sit, it can be a good thing, it can be a bad thing, but it's one where we'll get some guidance by the end of the year. The other pillar that we saw some good progress for Kenya, specifically for this quarter, was Pillar 2, and Pillar 2 was around access to FX foreign exchange. Obviously, we spoke about the reserve levels are still quite healthy. slightly below or just going under what the baseline should be. But we are confident that with the new IMF program that has been approved for this month, $234 million should be able to hit the account this particular month and should be able to give us a buffer in terms of that. In terms of areas of improvement, and which are critical, because for the development of capital market, without these pillars, we're not going to be able to progress. I think Pillar 4 was critical. How do we accelerate capacity of local investors? And that's why we need to get our framework around our pension environment. How do we utilize pension funds as source of capital, not only for Kenya, but within the continent becomes quite topical. And what asset classes are we going to offer as solutions to this pillar? The other one that came out quite close from that particular pillar is, again, on pillar number on the areas of improvement, we got two pillars. We got the last pillar, legal framework. I think that needs to be accelerated. I'm happy about the MCMRA framework that's going to come in place, that's going to help us to drive the secondary money market trading, and which just be able to give us more opportunities on how to drive the market going forward. I'm also excited about Pillar 4, which I spoke about, and one where we continue driving. So in summary, good score for Kenya, position 8 from position 10. Our act and our hope is that we'll be able to get to top 5, and some of those things that I've spoken about is what we expect the Kenyan market, be it the commercial banks, the CMA, and the NSC to help us drive. I'm happy to stop there, and I will take up questions thereafter. Thank you so much, and thank you for listening. Appreciate it.
Thank you so much, Stella, for such a detailed presentation. And thank you to everyone who's still with us here and joining us online. We'll give you an opportunity to raise the questions out of the presentation, but also from the panel session that is just about to kick off. So please do share. If you're online, please write to us on whatever platform you're using. Just use the hashtag AFME22 or the hashtag Africa Expertise. I'll repeat, AFME22. And Africa Expertise will be able to track your questions and answer them. So just hang around. You'll get all the answers to any questions that you've had from Jeff's presentation and Stella and the session that is about to start. Right, so we'll shift gears slightly to really get to understand how that performance, as explained by both Jeff and Stella, can be used for your business, and what are some of the opportunities that are thereof that we can still use in this space. And so as we kick this off, I'd like to invite to move to this next session and invite my panelists to join me on stage as we do this. Is my mic on? It's on now. Okay, great. Let's give a proper round of applause as they come. These are the smart people who understand what was happening here, so welcome. And my friends at Absa have asked me to apologize that we don't have a lady on, but Stella has ably represented all of us, okay? Thank you, gentlemen. I know we've consumed quite a lot of data in the past two presentations. And I think the next bit is just to really help a lot of the investors and a lot of the people in the room to really find their piece of the puzzle in this. So, ladies and gentlemen, for the next few moments, we'll try to wrap our minds around the question of harnessing the African opportunity. You've seen the data, you've seen how Kenya has improved as a market, you've seen the factors that got it there. And we'd just like to dig in a little deeper. But before that, allow me to quickly introduce my panelists. On the far right, we have Mr. Wolfgang Omondi. He is the head of trading at Absa Bank Kenya PLC. That's a good place to clap. Thank you. Next, a person who is not a stranger to these conversations, the Chief Executive Officer at the Nairobi Securities Exchange, Mr. Jeffrey Odundo. And right next to me, we have the Capital Markets Authority Director for Policy and Market Development, Mr. Luke Ombara. Gentlemen, thank you for affording us this opportunity to just dig deeper into this conversation. I'll start off with Luke. I mean, you've listened through Jeff's presentation where he gave an Africa-wide view. If you could just give us a sense of, from where you sit as a regulator, just give us a picture of how we're doing regionally as a capital markets, and what, in your view, is driving this growth.
Yeah, thank you very much. I'll just pick up from the presentation. I think one of the things you'll be able to see at a glance, which is positive, is the diversity of products across the continent. We've seen, I think we got the example of Morocco, not just green finance, because that is what has been captured, but if you look at the entire scope of ETFs, you look at REITs, look at derivative products, one thing is that it appears the appetite for more sophisticated products is really going up. But the true story when it comes to actual performance is measured by a number of parameters. I think what we can see at a glance is a continuous negative impact on performance, particularly with regard to liquidity. Or let's start with just the drop in the indices. Mauritius up to 21%. Most of the countries, Nigeria, Kenya, between 14 and 15% drop in the indices, and of course, by extension, market capitalization. Interestingly, I think, and that sort of aligned with what was presented around Botswana, I think that had the lowest in terms of decline of about 2.6%. So overall, a decline. We are seeing the impact of COVID extending to other global shocks. When we just thought we were trying to manage COVID, of course, we have all the other risks that have come up: interest rates, energy crisis, global supply chain disruption, all these other global shocks, Ukraine, Russia, has had an impact. And then when you get to the number of listings, there's also been a bit of, there was a bit of an improvement after COVID, but even the most promising countries like South Africa, you may recall, had 24 delistings in 2021. But there's also the positive bit, of course, we must. So as a result of rising interest rates, there's been a bit of a growth in the debt market, particularly treasury bonds.
Right.
And it's a combination of many things. First, I'll stick to the Kenyan perspective. Government has had a very close focus on infrastructure financing.
Right.
So you've been able to see quite a bit of growth in that area, where we have a number of infrastructure bonds that have been issued. But sticking to the bond environment, where I think that's where we've seen most positive growth. I think we mentioned the gender bond, Jasiri bond, Tanzania. I think all these problems, particularly on climate change, has led jurisdictions to rethink sustainability products, and therefore you're seeing, if you look at Cote d'Ivoire, I think during the COVID time, they did a COVID bond. It's not just green bonds, you're seeing social impact bonds, just the whole area around ESG.
Right.
Then another area that we've seen grow is on the fund management space. Of course, we focused on pension schemes, but if you look at, for example, Kenya, in 2014, we had assets under management for collective investment schemes of about 54 billion Kenya shillings. As at end of June, I think that was mentioned, that has gone to 148 billion. So in as much as we are saying, yes, there's the pension per capita, which has brought the scores down, I think there's need to consider that there's also growth in other forms of pooled funds. So it's not just pension schemes if you're going to look at collective investment schemes. So, and then, I didn't know to what extent you'd want me to go, but you can see, I'll just touch on one.
You've mentioned quite a few things that I would like us to revisit, especially on the growth of the debt market as well as the interest rate. So just let's put a pin there, but let me just bring in Wolfgang. Very incredible data has been shared here already, and it's been 6 years of putting together such rich data, especially for an investment point of view. But from where you see it, are investors or corporates or involved citizens fully utilizing the opportunity that we are currently seeing here in terms of making these numbers work for their businesses and their investment decisions?
Yeah, thank you, Bonnie. Of course, very valid question. Obviously, you know, the 6 pillars are of immense importance across basically all sectors. But, you know, I think to answer you directly, of course it is yes, but maybe the scale and the magnitude and also the depth might sort of vary from industry, from sector, or maybe even from business to business. Right. So you might find that if you are in maybe the manufacturing sector, for example, of course ESG is the topical thing right now, it cuts across, but maybe what aspect of it, you know, if you're in manufacturing, you probably talk about waste disposal, how you dispose of your waste and you know, things like that. You probably look at, you know, hiring of maybe people with disabilities and sort of things like that. But then, of course, you know, your next focus might be maybe the FX pillar, for example, or maybe the regulatory environment. If, for example, you are maybe a larger corporate, you know, that might just expand a little bit more because you're being looked at. If you're publicly quoted, you're sometimes even being called out and so on. But, you know, your focus would be from the ESG to maybe cut across pretty much all the 6 pillars based on the size of your company and, you know, what industry you are in. If you were, say, you know, from a public sector lens, then obviously, you know, issues around what Stella talked about, you know, the pension size per capita, that's something that could possibly drive some policy interventions. And I know that there are already discussions about enhancing NSSF contributions and things like that as we go on. And of course, if you're, you know, an investor coming into the market, then, you know, issues like market depth, you know, local corporate understanding, or local understanding rather of you know, the markets, and maybe the economic transparency piece, all these things, you know, would certainly be more important to others at different points in time. But I think overall there is a general appreciation that each pillar is important in its own right. Right.
Great. Jeffrey, one of the key drivers of Kenya's growth has obviously been around the incorporation of ESG frameworks. And COP27 is here, Africa's COP. There's a lot of commitments that are set to be done. And African is here, Africa's COP. There's a lot of commitments that are set to be done. And African investments and businesses are quickly realizing we need to take care of the planet. Just from a very, from somebody who observes this market and operates it, what's the big deal about ESGs and how important should they be on our priority list?
Thank you very much. First of all, I want to just say I'm happy to see Kenya has moved 2 places up. I think that's a positive sign. And we did very well on the ESG assessment, which I think is very, very important. Now, ESG assets are becoming increasingly attractive to investors. One, largely because of the whole agenda towards climate action, which is something that is being embraced. You can see governments. I mean, when I saw the UK new Prime Minister saying that he was not going to go to COP27, there was this whole hue and cry for him to go, and he's actually there. That's a very positive sign. So given that there's this whole climate action, and you can see the impact of climate change across the globe. I think conventional or traditional assets or conventional fund managers and owners of capital have now provided an asset allocation for ESG assets. So it's something, it's not only a good to do, but I think it's necessary for the survival of our people and for the future protection. So given that importance, investors are now looking to invest in assets that have got some level of ESG content. And so companies that are even listed at the exchange have now embraced ESG and are offering tangible solutions or tangible assessments that you can actually be able to look at this company and be able to measure or even rate whether they're ESG compliant. Yeah. Now, how they're doing this, we have encouraged companies to do sustainability reporting, which is really the highest level of ESG assessment and integrated reporting, and this is being embraced. And what that is doing, it's increasingly increasing the attraction of those companies in the eyes of investors. So investors will come, look at this company, find it's profitable, but are they ESG compliant? They will make a second, actually the second decision could even make them decide whether to invest or not. Right. It's no longer just about profits, but it's about people and planet as well. So they're very, very focused on that. We have been very deliberate at the NSC towards encouraging firms to comply with ESG standards. So we released an ESG guidance manual last year that just provides you with a very simple to-do framework, so that you get away from doing the annual CSR and think you're ESG compliant and actually do things that can be measured around the environment, around the social communities, and around the governance.
But what sort of incentives are there? I mean, there are companies who are saying, we're happy with the bottom line, we're treating our people well. What would get them to cross over to take ESG seriously?
I think the first thing is that, as I said earlier, there's a high correlation between ESG compliance and profitability. Clients will want to relate more with companies that care about them. So today, if you're basically just offering products to the market and you don't care, you're not even taking care of that very market that is supporting you, you have no social programs, you have nothing to give back. Sooner or later, you'll find your performance dipping. So there's a direct correlation, just speaking from a business standpoint. Right. The second thing, the governance component. Now, what is the biggest risk to any investor is getting back the capital you invest. Right. So if you're a company that has got no interest in governance, I mean, you're basically running this company for profit and you have no interest in even involving or putting best business practices, then sooner or later you'll have a misperformance in your assets. So they're very tangible benefits, and they're very intangible ones, like things around brand, things around responsiveness, things around a global appreciation of what you're doing, than just thinking that it's all about profits.
Right. Interesting. Let's move to a point that Luke mentioned. You talked about the growth of the debt market and the fact that government paper is becoming ever so lucrative as an investment. But what is the impact on the other source of investment? Do you see these as a factor that discourages, say, equity investors, for example, because the return is not as guaranteed or as high as government paper?
Yes, certainly there's a big impact, because you'd ask yourself, whether your fund managers here, whether it's in the commercial bank, would I rather go for equity if government is offering, I think the latest 14.1%.
Right, guaranteed.
Yes. And at some point, you'll even, if you look at the example of infrastructure bond, it's not only 14.1%, but there's no withholding tax on interest income. So effectively, the disposable income is huge. So the question is, what business do I have getting into the other asset classes?
Right.
So we've seen that have
especially
an
if you're a
impact.
small ticket investor. Right?
Yeah. We've seen that actual impact, not just in direct investment on listed equity stocks, but it has now even stretched to asset classes within collective investment schemes. We've seen some indications that some fund managers would want to wind up their equity funds and probably stick with money market funds. So, of course, as we speak, for example, to fund managers and trustees, it's only fair to also indicate that as an asset manager, even though we say these are gilt-edged security, a treasury bond, we have seen instances where there have been defaults. So it's not something we can really say it's absolutely risk-free. We've seen defaults in various Lebanon. We've seen, I think, okay, let me not mention them, but they're there.
But then, look, sorry to jump in, but is this an issue that requires, I mean, if you're to talk about encouraging local investors, right, in the equities market, is this an issue that requires policy intervention, or do we leave it to the market to correct itself?
Well, what we would, first of all, and I think that's the point I was coming to, was that first you will ask a fund manager, why do you have to sell your investment policy? Why do you have to give your offer memorandum to investors, while they can walk into central bank, open a CDS account, and be able to purchase securities, government securities, and still get 14%? What are you getting? What are you getting the management fee for?
Right.
What are you getting the trustee fee for? The custodian fee for? So it's basically, why don't you diversify? Why don't you diversify?
Right. And so it goes to innovation.
Exactly. But that aside, because we have retail investors who must be protected, as a policy measure, one of the things that we've been seeking, not very popular, but we've seen it in other jurisdictions, is to try and get the retails to come in through the pooled schemes. Because here they have the benefit of a fund manager being able to allocate the portfolio along various asset classes and diversifying the risk, and also mitigating the possible market risk from concentration on one asset class. So we are thinking of, if it's not just collective investment schemes, which I had indicated is growing tremendously. I think South Africa at some point, I stand corrected, but there was a policy that, yeah, if you want to get into the stock market, equity, you must do it through a CIS. We'll remove a lot of headache around that. Then lastly, of course, as I said, just from point where I started, there are investors with growing investment appetite for alternative products by default. They no longer find even treasury bonds attractive. There's a group of youth, 75% of the population, which probably would prefer to make instant capital gain. So the traditional products would not really be quite appealing to them. So if you can get them, for example, and Jeff will bear me witness, to get into day trading, buy your securities at 9 o'clock, sell at 10, buy at 11.
Excitement.
Yeah, then that excitement.
Jeff, I'd like your view on this, as well as Wolfgang, on that balance. How do we ensure that both markets are growing?
I think listening to Luke, I was basically smiling because I think, have you heard about, I think the Kenyans, we're always accused of having a herd mentality. We all follow one direction when something is exciting. I mean, remember we bought quills and we chase all these sort of things, gambling and everything. So that herd mentality is extremely risky. Right now, the herd mentality is towards government treasury bonds, right? So we're all going into these bonds. We're saying that the equity markets is not attractive. The alternatives are not attractive. But one thing you're forgetting, that if you're going to go into the bonds and there's continuous rise of interest rates, and we anticipate interest rates might continue rising, given the global issues we are seeing. You carry what you call a duration risk. So whatever paper you invest in today will be underwater with the next issuance. And you'll all be doing that every day, because you'll be pricing extremely high if the government doesn't change their borrowing requirements. Now, for pension funds, it's a no-win situation, because all the bonds you bought in the past will be undervalued. And I don't understand why they don't see the duration risk. I would support bonds for retail who can hold it long term. A balance for fund managers. Unfortunately, fund managers they can't do it because of duration risk. But they need to start looking at alternatives. Sure. I keep advocating, and people think that I'm always marketing equities. But the equity markets that we have right now are trading at all-time lows, 9 times earnings. Any slight movement in the direction of interest rates, the equity markets will just rise.
Right.
And really outperform the bond markets. And if you look back, I mean, you're looking at small stocks. I mean, even your own stocks. Let me use the NSE, for example. We've traded at an historical high of 28 shillings. We're now at 8 shillings. And we're giving you dividends. 85% of my earnings goes back at dividends. But people don't see that value. So I think there's need for that mind shift. Secondly, we have new solutions. You talked about day trading. Our market has ability to day trade, right. Meaning that you can buy and sell same stock, same day. We have security lending and borrowing framework, which we've put in place. We have derivatives, which have also new products. We have ETFs. I mean, do you know the Absa ETF in the last 2 years has actually outperformed? I mean, from 1,250, it's now at about 2,000 shillings per unit. And we extinguished the first allocation. And I think we're about to extinguish the second allocation. So I think we just deserve a clap for that. But we always focus on one asset. So there's a serious risk, and we need to shift that education, financial education. And as Luke said, we would like to see retail being aggregated through CISs.
Right.
It makes more sense. Put your money in a unit trust, let the unit trust fund manager invest, because they're professionally trained. If you come directly, make sure you understand or have a professional to help you.
Right.
So we've got those challenges. But to your point, I think we have what will trigger this market. One will be new listings. The government is looking at a pipeline. We have got a pipeline that's going to increase performance. Secondly is retail. We want to increase retail access. We want to increase retail participation from the current 10% to a very good proportion of the market. The use of alternatives, all these products we've brought to the market, financial education, that's what we want to do, to increase the domestic pool.
Right. Thanks, and thanks for the investment team for the day. But Luke, I'd like to quickly just respond to that, but also to address the other issue that I think was in Stella's second pillar, on the issue of access to FX, which I think is a big challenge on the African market. We are continually seeing a lot more nascent markets joining in. So if you could quickly respond to the issue on interest rates, on government bonds, but also let's talk about FX.
Okay, for FX, I think that
All right, he jumped on it, but
that's even better.
All right, you go. I'll come to you right after. Go for it.
Yeah, so I think the two experts talked about, markets. I think my contribution to that bit around equities vis-a-vis bonds is, markets certainly go through cycles. And this is just one of the cycles we're going through. Equity prices, despite, price earnings that Jeff talked about, just do not seem attractive. And another dimension to that is, of course, offshore participation, because we must accept that, offshore participation in the equity markets, as well as the bond space, has substantially reduced. So until we get, a bit of stability or a bit of confidence back into the system, we do know that, prices will obviously remain suppressed. So that probably needs to come through. And that actually leads to your second question. So obviously, it's not news that there are liquidity challenges in terms of accessing hard currency. It's been with us, for a bit of time, so to speak. And it's actually not unique to Kenya. I guess each emerging market, if you will, particularly in the African space, is going through some of those challenges. One, of course, we have high levels of foreign debt. Secondly, a country like Kenya imports quite a bit. Actually, I think the ratio is almost 1 to 3. Yeah. So obviously, the currency, the local currency remains on the back foot. But of course, from an interventionist perspective, there are certain maybe near-term and longer-term activities, that could be put in place to try and see if we could mitigate. Of course, when it comes to the fiscal bit, we might need to see how to review or ease back on some of the foreign borrowing. I know that we are gravitating slowly to the IMF, and that comes at least with a bit of concessions, a little bit cheaper, a little longer in terms of duration. So that might sort of ease that pressure as opposed to going to, your Eurobond markets or even maybe syndications, if you will. The other, of course, and I'm speaking kind of broadly, would also just be around, policy. So if we have diaspora flows, for example, which are the largest contributor to FX, and largely go to support, families and so on, it would be better if we could enhance, the component that comes to the investment space. Right. So we talk about maybe venture capital, and things like that. These funds, so if you follow it, it moves into venture capital, it moves into other forms of investment, which hopefully generate employment, which ultimately contributes to economic growth.
Right.
But then the other thing, of course, is self-reliance. You see, why do we have to import wheat from Ukraine? Why do we have to import maize from, another country? What is it that we can do to enhance our own reliance on some of these import items that will ultimately ease some of the pressure on the currency?
Right.
So I think those are some of the discussions, and honestly, within the government space, we've had discussions around enhancing those things, and I guess maybe in the longer term that would come through. But I think for the short term, it certainly looks like this turbulence or the liquidity constraints that we have are obviously with us. Yeah.
All right. I like, Luke, you had an intervention on FX, then I'll come to the audience for a few of the questions. What way forward, really? Because Wolfgang has proposed a couple of interventions. Some are policy, some might take longer than we expect, but from where you see it, are there quick remedies to this?
Okay, maybe I'll just speak to one point,
right,
because central bank has already pronounced itself on the forex issue. So I'll just pick from where he spoke about diaspora remittances and whether that could be short-term or even long-term, depending on where we get them to invest. And as the CMA, we have advocated for a long time around the issuance of a diaspora bond. Perhaps it's about time that we could be able to divert those investments towards what is largely their approach currently on consumption. Mm-hmm. It's mainly used towards consumption. So if we can be able to get the government or even at corporate level, proper structuring of diaspora bond, perhaps also flavored with mobile technology, like if they can be able to basically just subscribe to the same, that could partly alleviate the same. I think I'll stop there. I repeat, the central bank.
Please go ahead.
Yeah, this is a very interesting subject. I didn't know I'd be drawn into FX conversations, but yes, because we also impacted on as capital markets. I think it's important to note that. But most of the solutions are actually within our reach. One of the key ones that I think is going to be helpful is to make Nairobi a financial center where expatriates can come, live and work here, and companies can relocate their regional headquarters here. I think Kenya has attractive incentives. If you look at the ability for you to access work permits, if you're looking at the lifestyle we have, if you're looking at the financial infrastructure we have, the social infrastructure, I think we rank very well. I think those who travel around Africa can actually bear me witness. I mean, I think outside South Africa, we probably have the most beautiful city in Africa. And with that, you will attract foreign direct investments. You'll attract big fund managers who will play in this market. They will come live here, and also with them, Forex will follow. I think that's one thing that we should probably park somewhere. The other thing is investment promotion of Kenya as an investment destination. I think we promote Kenya as a sporting and tourism destination. Other countries are looking at promoting their homes as investment destinations, and that's why I like the refocus of government by creating a specific Ministry of Investments, which is going to be focusing on promoting Kenya as an investment destination. Right. Because we have it. We have what it takes. So that I think is going to also enhance the attractiveness, of course, with the other incentives that we put in place.
Okay, great. For the interest of time, I'd like to take any questions on the floor. If you have, and be specific who you'd want to address. Also, if you are still online and you'd like to share a question, please do so. Use the hashtags AFME22 and we'll be able to take your questions. But do we have a question on the floor? Going once? Twice? Before I come back to you, there's a question that, yes. While you get the mic, let me just throw a question specifically to Jeffrey, because we've seen new entrants that are scoring fairly well based off of this report. How big a deal is the digitalization of the markets, and how far do we still have to go as a market?
Digitization and digitalization is front and center. No market will survive if they're not agile enough to adapt to new innovations. And so you must put the digitization right at the center, both in terms of your infrastructure and even products. I think today the fastest growing sectors are in the financial services, are things to do with digital assets. I mean, if you're talking about online forex trading, if you're talking about bitcoins and all these kind of things. I think we must be alive to the fact that that's where the future is going. We must invest in those areas. So for us, it's very important. During COVID, this was a real thing. The markets had to go full virtual, and those markets that didn't move very fast were impacted on. The new demography, the youth, I'm told they want to do things in 2 clicks. So if it's going to trade, open, buy. Not open, fill a form, submit 48 hours, no. It has to be 2 to 3 clicks. So this is the kind of future we're facing. It's quite aggressive. Things of use of new technologies like blockchain and AI and all these kind of things, we have to learn them, right, so that we can remain relevant in the future. I mean, we went to a world conference in Malta, and I think about 5 countries are now offering digital assets, including cryptos. So right, this is something we must be alive to.
Right. Yeah. Great. Thanks. Let's take a question, please.
My name is Elizabeth Kivuva from Business Daily. I have 3 questions. One is from the report. There's on the reserve coverage in terms of the months. Just want to find out when was the report covered, because I think there's a time on that it was almost like 4.3, and it's seen from the report is 4.4. So I think 4.1 is quite low, which I think maybe you're giving Kenya, I mean, like in terms of the foreign exchange, quite a credit when maybe I don't think I don't feel like we are there. And also, was it in terms of the reserve coverage, was it covering, did that indicate a measure cut across all the countries? And number 2, I think Stella, or someone from the panel can take this up. There's you've really raised concern on the external debt, but I think if we are not looking at domestic, I think it's quite higher than the external debt at the moment, or maybe just almost there,
Right.
which I think the domestic debt, I know every Kenyan, as long as you have CIC, you're an investor, so we don't get too much worried about the domestic debt. But why are you raising the questions in terms of the concern on the external debt? Is it in terms of the servicing and the currency fluctuations? And the last one on the, to Mr. Geoffrey Odondo, you've mentioned about you're looking to increase the access, retail access, I think from current 10% in the NSE, I think. That's what you're mentioning. I think what measures are you looking in, maybe into details, how are you going to increase this?
Okay, great. So I think Wolfgang, you'll take the question on debt. Jeffrey has his question, and then later on I'll bring in Stella to answer a question on the period and the review, okay? Could we take another one, then we answer them together? Yes, please, at the back.
Thank you very much. My name is Teresa Anyango from Torrent, East Africa. My question is around, I noticed that pension fund seems to be having quite a significant impact, particularly in the not so good performance of Kenya. Of course, where we stand as Kenya, we always expect to be not anything below number 3 anywhere in Africa. So looking at ourselves performing so poorly in the pension fund, my question is, where have we failed? Whose responsibility is it? What are we looking at? And what will be the impact of the proposed law of 6% NSSF recovery towards the pension fund? Is it going to improve this index or not?
Right.
My second question is, okay, this research was based on Africa, but I want to believe the researcher must have had some idea about what the global performance is. So where is Africa and Kenya placed in the world? Thank you.
Thank you so much. The first was a set of difficult questions that I think Luke will take. And then I think Stella will also come back to look at the global context. So let's take those ones for the interest of time. We'll start with Wolfgang.
Yeah, thank you. I think your question was generally around the FX situation. The fact that, maybe, on the ground, it's sort of observed that we have liquidity constraints in terms of accessing foreign currency. But at the same time, the rating seems to have, come a little better. I think one was probably the way that the rating was done, or the analysis was done. Obviously, we introduced reserves. Reserves are a component, and Kenyan reserves are also, quite good. I know we've seen a decline, particularly last week, so we're just trending at the slightly above the 4-month level, but generally good, and we've also seen some good support from the IMF and so on. So that is what would probably have helped boost the number, because it's a combination of factors. The other, of course, is in the previous build of the data, we were not, or the researchers were not able to get all the data that they required. They had put in requests, some even to the regulator and so on, and were not successful in getting that data. But this time around, they were able to get data around, interbank activity, sort of activity in different sectors and so on. So that transparency, for lack of a better word, is what added to, the improvement that you saw in the number. But it's of course not lost on us that the liquidity challenges do exist, and it's just some turbulent waters right now. But hopefully at some point the interbank market will come back to life, and you will probably definitely see some of those spreads narrow. In terms of the FX debt bit, why of course it is a concern. I did say earlier that Kenya, in terms of import vis-a-vis export, we export almost 3 times more than we import. So if you add foreign debt to that component, then of course it could lead to additional pressure on the currency, because remember, that our regular KRAs and so on, they are paid in local currency. So it is, one of the options or one of the methods that they could use to retire some of this foreign debt would be borrowing additional foreign debt, in other words, rolling over, or alternatively, coming to the local markets and buying hard currency to service the debt. So it does have the effect of putting additional pressure on the currency if it is not managed well. That's not to say that it's not managed. I mean, I'm just bringing out a point here that that's why debt issues come in. And then, of course, with foreign debt, some of the investors who invest, particularly in the Eurobonds and so on, this is some of the data that they look at. So it is important because, like I said, as an importing country, the strength or the weakness of your currency has a direct correlation onto how economic activity takes place.
Okay. Just one comment on the pension, then I'll go to my question. If you look at this, the way they compute the local participation, we are taking the total size of pension assets, value of pension assets divided by the population. So for instance, Namibia, the population of Namibia is 2 million people, 2.5 million. You're comparing that to Kenya, which has 50 million people. We will never be able to beat Namibia in that number. So secondly, also if you compare the total number of pension assets to domestic listed companies, again, the parameters, the denominating parameters are wrong. I think what we need to do, and maybe feedback, is that you need to do what you call peer group assessments. So jurisdictions of similar size, same population, if that's a key assessment factor, has to be measured together so that you can get the real score. Otherwise, you will always underscore Kenya on things like domestic investor participation, even market size. I think these are things that we need to maybe feed back to the assessors so that we can have a fair rating. I think we probably could be number 5 or number 3, as you suggest, if we adjust for those small corrections. Now, on the issue of access to markets, I'll say 2 things. Number 1, what's going to change retail mentality will be financial education. We have to invest using proper education. And invest education should actually start at basic level. So we're saying, let it be part of the curriculum. As you grow, you know that wealth management or wealth creation is something that you have to do in life. Just like as we grow, we were told you must buy property, isn't it? So we change our mentality from property, we just put in just a bit for wealth management, and that's very critical. And number 2, we must excite the market. So we must bring products that are relevant, listings that are exciting, so that the markets can react. So I think those are the two things you can hold us to account in a few years' time. Thank you.
All right, Luke. Yeah, I'll weigh in on all 3 issues. I think first of all on forex. As Capital Markets Authority, we have made previous proposals on how you can address forex issues. I mean, there are other options other than what we have mentioned. We had, I think, at some point proposed bilateral currency swap, for example. So just trying to hedge against fluctuation in the currency, especially depending on which country you're seeking the debt from. So there are very many issues. We can open our minds and see what other. Then on the numerator denominator crisis on pension schemes, mine would have been, I think it's still a good start, but if you really want to measure, for us who are under pressure, I'm head of market development, so if there's no domestic participation, of course, I'm already in trouble. But if I was to use an option like what percentage of security holdings are held by domestic retail investors or held by institutional domestic investors, perhaps that would place us way up there. Okay. Then on the issue of access, I think my chairman would have killed me if I hadn't talked about it. The area of innovation, particularly accessing finance through technology, that is the fintech space. And we have seen an emergence of very many innovations. We had the crowdfunding, debt crowdfunding platform by Pezesha, and now we've already seen many other solutions coming to be tested on the capital markets regulatory sandbox. So it's how we can be able to use technology to reach out to many other people, crowdfunding, equity platforms, debt platforms, or generally investment crowdfunding platforms, and not to overemphasize financial education. I think His Excellency the President himself has made that commitment in the KK manifesto. There seems to be an issue around the financial sector in terms of how much information they have, not only to be able to invest, but also to protect themselves, because a knowledgeable investor is a protected investor. Lastly, just on the pension bit, I think we still appreciate that we have, I think, currently assets under management of about 1.5 trillion Kenya shillings, but a lot more can be done. Again, I think it's the issue of excitement into, there's the issue of tax. There have been concerns around whether it's attractive to be in a pension scheme when at the point of exit, there isn't sufficient incentives in terms of tax. But I think it's awareness when it comes to the financial sector, except for banks that are traditionally known over the years. If it's pension, insurance, capital markets, we really must step up on financial literacy.
Right. Great. If we could just get the microphone to Madam Stella to respond to the last two questions, and we bring this to a landing.
Thank you, Bonnie. So, as I said earlier, Jeff is actually online. So I'll allow Jeff to take up the two questions.
Okay.
But maybe what I just want to add, the question around the pension environment. So a couple of things that I did mention, that one of the things we're seeing is that pension funds are going to become source of capital going forward into Africa. But again, there are a couple of things that are coming out there. One, around innovation and diversity. I think that's going to be critical, and more around what's happening from a macro perspective. I think the third thing is trustee and regulation challenge. There has to be a lot of education for the trustee funds, just to understand what other alternative asset classes are there from an investment point of view. And obviously then the bigger challenge is us as the commercial institutions, obviously working with the CMA and NSC to craft solutions that offer those alternative asset classes. I think those are going to be quite topical. So I just want to add on that. Jeff, can you hear us?
I hear you.
Great.
Hi, and sorry for interrupting this very good discussion by remoting in. I think there were three things that struck me. At the risk of prolonging the pension fund discussion, I suppose from the index side, maybe a little initial pushback. I hear the argument that an Eswatini or Namibia or Botswana have much smaller populations, but if you think about the importance of pension funds and why they're in the index, the importance of this is they're seen as sort of long-term focused capital provider. And so in that space, regardless of whether your population is large or small, you must have a goal to generate sort of long-term capital, because that is really what helps our groupings here. And in that space, Morocco having about 4 times the pension assets per capita as does Kenya. But let me touch upon the two questions originally directed. One was around foreign reserves. And I think the person who offered the question did so in an excellent way. She asked the question whether there might be a timing issue here. And I think that's a large part of the answer. Of course, we have different data edges as we collect data for different types of data, but we also try to make the data edge similar for all countries. So when we measure foreign reserves and then we divide it by months of imports, Kenya's data is quite timely. That's why we're discussing it, given the data that was out just a few days ago. Other countries, it's a bit slower. So the foreign reserves as a proportion of imports, that data locked in at the end of 2021. And so the 2023 index will give us data to the end of 2022. There was another question asking about why the focus on external debt and why sort of admitting local debt. I mean, all discussions of debt are highly topical across the continent right now. They've been topical in Kenya almost as long as we've been doing the index. The simple answer in this space is that whilst it's not impossible for countries to get into real trouble with too much local debt, and I certainly don't want to tempt fate on that side, in the vast majority of cases, either here on the continent or globally, countries that really get themselves into a difficult corner are countries that have, in some sense, too much external debt. And so that's why we've chosen just that part of the debt to include in the macro pillar. But 3 quick interventions there. I hope that you found that useful.
All right, great. Thanks, Jeff, for that. For the interest of time, ladies and gentlemen, I'd like us to bring this to a closing, but my panelist, last question, if you could answer this in one sentence. How do we harness the African opportunity, starting from Mondi coming down? Yes.
I think I did touch on it earlier, and I think there's an element of self-reliance, self-sustainability. It might not be across the board, but we've got to start somewhere, because we can't import everything, including toothpicks. You know, we need to get to a point where some of these things we stop and we allow local industry to pick up. So I think that's the narrative that needs to be flipped. It's a long story, but you said one sentence, so I'll just stop there. Thanks.
Jeff?
I think Africa needs to trade more with itself. And how we can do this is 2 ways. Number one, we establish trade linkages between our countries. And number 2, let's trade and let's improve on our comparative advantage. If Kenya is good at something, let's be the specialist center and import whatever you need from Uganda and vice versa. We must encourage inter-Africa trade. Thank you.
Fantastic. Luke?
For me, charity begins at home. We need to build our domestic market. First of all, to address the risk we're already facing around foreign outflow, because we were relying on foreign investors to drive our market. Then I think we also need to provide long-term, cheap access capital to small and medium enterprises, because that really, in my view, is what's going to drive capital raising and expansion. And then after that is when you're going to get into what Jeff is talking about of intra-Africa trade.
Right. Thank you so much, gentlemen, for your thoughts throughout this session. Round of applause, please, to my team as they take their seats. Thank you so much for your interventions. Asante sana. As my team takes their leave, we are almost coming to an end. But let me just acknowledge that there's quite a couple of people who have been joining us and have been with us online. Thank you so much. We appreciate your time, and keep sending your questions. We'll still have our teams be able to respond and send that feedback back to you. At this point, I'd like us to shift gears again and bring on stage the managing principal for corporate and investment banking for Absa Bank Kenya PLC, Mr. James Agin, to give us closing remarks.
Thank you very much, Bonnie. the Nairobi Securities Exchange CEO, Jeffrey Odundo, Luke Ombara, Director, Policy and Market Development, CMA, our interim CEO, members of the Fourth Estate, distinguished guests, ladies and gentlemen, good morning. It's really been indeed a pleasure to host you this morning, and I hope those of us in the room and joining us online have really enjoyed the conversations that have taken place and find them useful and beneficial to the future discussions around policy approaches and how to spur the African growth and development. As we close, I think it's important for us to reflect on some statistics which will be relevant to this discussion and definitely help us as we go around deepening our financial markets as a continent. So today, Africa is home to about 1.2 billion people, and the expectation is that by 2050, that number will have doubled to about 2.5 billion. And out of these 2.5 billion, of course, we're seeing the natural characteristics around good numbers of emerging middle class. I think it was mentioned about the population demographic, rapid urbanization, and of course, the massive growing labor force, in which currently standing at about 700 million. In the next 10 years or so, that number should cross the billion mark. And I think that definitely presents therefore a very, very huge market for investment opportunity, and of course, a population for business to actually thrive in. In addition, as Africa, thrives to achieve the 2030 agenda on sustainable development, and likewise the Agenda 2063 of the AU, while cannot miss the fact that managing the challenges and combating the consequences of climate change will therefore require a lot more innovative sources of funding and very, very inclusive financial services. Undoubtedly, therefore, expanding and strengthening our financial markets remain a very key pillar for taking the continent to the next level. And therefore, it's extremely imperative for us to all continue encouraging financial markets across the continent to operate in an open, fair, transparent, and well-regulated environment, and that is therefore going to stimulate opportunities currently and into the future. And therefore, for us as Absa, one of our key desires when we host this kind of forums is to just ensure that the robust discussions around deepening of the financial markets among policymakers, governments, private entities, customers, investors, regulators remains very, very much alive. And of course, what's important around that, that as much as it creates an element of friendly competition among countries, for us the goal is to have a collective uplifting of the financial markets in the continent and therefore spur economic growth. And therefore, for those of us who have not had a chance to go through the document, I invite you to download it. The link is on the invite that was sent to you, because within that document you'll get great insights on development of different financial markets, and most importantly, where we have thrived in certain markets and how we can then learn from our peers to ensure that as a collective, the continent then grows in terms of our financial markets deepening. And therefore, from myself and on behalf of the Absa Group, really like to thank you all very, very much for taking time to join us this morning. I hope you found the discussions useful and will be able to use the information to actually help play your part in stimulating the development of the financial markets in the continent. So thank you very, very much, everyone who took time to attend, both present and online, and wish you all a lovely day ahead after this session. Thank you very much. Have a good day.
All right, ladies and gentlemen, remember the link is on the invite that you do have. If you still have any questions on how to get the report, the Absa team is right at the back and they'll be able to assist you. That brings the proceedings to an end. Thank you very much. Have a lovely day.
How lucky we are to call this beautiful continent home. Yes, this paradise is not without peril, but just look at what we have to work with. In the years to come, this responsibility will fall to you, and all its potential will be your possibility. So we promise to do all we can today to share all our knowledge and skills, to ensure you inherit a just society, to give you access to the finance and resources you need to build the best Africa possible. But none of that will matter if we don't protect this beautiful continent we call home. And so we pledge to use every ounce of our creativity, our ingenuity, our tenacity, all 37,000 of us, shoulder to shoulder with millions of you, to bring the most important possibility of our time to life. So your world, dear tomorrow, is shaped by the power of zero.